We've made a lot of progress over the last couple weeks learning about fundamental tax concepts such as calculating federal tax liability and how we can automate the process using Excel. This video is going to provide a review of Data Analytics Project 1 with an emphasis of the goal of the project to learn how to calculate the federal tax liability using the rate schedule. You may find this video helpful both as you are reviewing for your first exam and ensuring that your Excel spreadsheet is set up appropriately. The goal of the first data analytics project was to automate the process of computing the tax liability for a single taxpayer using the tax rate schedule. Before we jump into Excel to see how we programmed this, let's review how we would do this manually. In the first problem, I'm going to have Amani earning gross wages of $16,800. You know that we get to remove the standard deduction from the gross wages, and this would leave us with taxable income of $3,850. Now that we've identified Amani's taxable income, the next thing that we need to do is we need to put it into our bracket to calculate the tax that Amani will owe on this taxable income. We find the tax on taxable income by first evaluating where the taxable income fits between the bracket minimum and the bracket maximum. In this case, the $3,850 of taxable income falls in the first row. So we would put that on the first row, and then we would multiply it by the tax rate on taxable income, and we would arrive at the tax liability on that taxable income of $385. In the first data analytics project, you also learned to go further such that you could identify the highest statutory tax rate. In this case, the highest statutory tax rate that Amani paid was 10% because all of his income was taxed at the 10% bracket. You also learned how to find the marginal tax rate. Remember, to find the marginal tax rate, we take the taxable income that the taxpayer is currently earning, we add $1, and then we compare this new level of income to see if it exceeds the bracket maximum. Since $3,851 is still below the bracket maximum, Amani's tax rate on the next dollar of income would be 10%. After we identified the highest statutory tax rate and the marginal tax rate, the next thing that we did is we identified the average tax rate. Remember, the average tax rate is found by dividing the tax by the taxable income. In this case, when we divide the tax of $385 by the taxable income of $3,850, we find out that the average tax rate is 10%. This should not be a surprise because all of the taxable income is taxed on the same row at 10%. Finally, we found the effective tax rate. The effective tax rate is the tax divided by the gross income. In this case, we would again take our $385 of tax and we divide it by the gross income, which in the first problem was $16,800. And we find that the effective tax rate is 2.29. Before we jump into Excel, let's do a couple more problems so that we make sure that we fully understand how to utilize the tax rate schedule. In this case, let's look at gross wages of $23,225. When we subtract our standard deduction, we find that the taxable income in this would be $10,275. Again, we're going to compare that against the bracket minimum and bracket maximum, and we find that the $10,275 is still on the first row. So we go ahead and put that in the first row. We multiply it by the tax rate in that row of 10% to identify the tax liability of $1,027.50. Now that we have our tax liability, we can locate our highest statutory tax rate. Amani is still paying 10% on all of his income, so that is his highest statutory tax rate. However, our marginal tax rate is going to look a little different. When we add that one additional dollar, we see that the $10,276 now exceeds the bracket maximum. So Amani's tax rate on the next dollar of income is going to be 12%. Let's do one more example. In this case, Amani makes gross wages of $55,000. He still takes the standard deduction of $12,950, so his taxable income is $42,050. If we were to use the table without considering that middle row, what we would do is we would allocate the first dollars of tax to the first row. So we're going to take our $42.50 of taxable income and we're going to split it up to the amounts that are allowed in each row. Here, we're again going to utilize the bracket maximum and the bracket minimum to figure out how much we can put in each row. We begin by taking the bracket maximum and subtracting the bracket minimum to find out that we can allocate a total of $10,275 to that first row. We would multiply that amount by 10% and find out that the tax on that first $10,275 of the taxable income would be $1,027.50. Because we haven't allocated the full $42,050 worth of taxable income, we're going to repeat the process moving to the next row. We'll take the bracket maximum less the bracket minimum to find out that we can allocate another $31,500 to that second row. We'd multiply that next $31,500 of taxable income by the 12% rate for that row and identify that we have $3,780 of tax owed on the next $31,500. Since we haven't allocated the full amount of the $42,050, we're going to continue on to the third row. In this case, the $42,050 does not exceed the bracket maximum of $89,075. So we're going to use the remainder of our $42,050 and allocate it to the third row, and then we'll subtract out our bracket minimum of $41,775 to find out that we have a remaining $275 of income allocated to the third row. This next $275 of income is going to get taxed at 22%. So we'd pay another $60.50 on the last $275 of taxable income. This yields a total tax liability of $4,868 for a single taxpayer who earns $55,000 worth of gross wages and takes the standard deduction. If we use the same process, we could identify that the highest statutory tax rate for this taxpayer is 22%. That's the maximum rate that the taxpayer paid tax on their taxable income. But the vast majority of their taxable income was actually taxed at 10 and 12%. We could also identify the marginal tax rate. If we were to add one more dollar of taxable income for this taxpayer, they would have $42,051 of income. Since that extra dollar doesn't exceed the bracket maximum of $89,075, their marginal tax rate would also be 22%. While this perfectly illustrates the progressive rate structure that we have for our tax code, we learned another way to utilize this tax rate schedule. In this case, we focus on identifying the row where the taxable income fits the bracket minimum and the bracket maximum. Once we found the appropriate row, we take our $42,050 of taxable income, we subtract out the bracket minimum of $41,775, and we find out that we have $275 worth of income that is going to be taxed in that third row. We multiply that $275 of taxable income by the 22%, and we arrive again at $60.50. We're not done though. We need to account for the tax that would be applied to the income that was taxed at the 10 and 12% tax rates. Your rate schedule has the cumulative tax that would be paid up to this particular row. We take that cumulative tax and we add it to the $60.50 to arrive again at the $4,868. Now that we've reviewed how to compute tax liabilities manually, let's see how we programmed Excel to handle them. Automate the process of computing the federal tax liability, identifying the highest statutory tax rate, the marginal tax rate, and computing the average and effective tax rates. We created an input-output summary tab that contained basic information about the taxpayer. We entered their filing status, their gross wages, and the standard deduction. Then we entered our first formula, which computed the federal taxable income, while being mindful that you cannot have negative federal taxable income. We made sure when we created this formula that we used an if condition to allow the federal taxable income to be zero if the standard deduction exceeded the gross wages. Our federal taxable income was linked to a rate schedule via cell B13. We created conditional formulas that mimic the process shown in the last example, where we're identifying the row that the taxable income fits between. Once we identified the appropriate row, the formula would then subtract the amount of taxable income from the bracket minimum to arrive at the taxable income that would be taxed at that row. We used a different conditional formula to compute the bracket tax liability, allowing it to be 0 for any row where the taxable income is 0, multiplies the taxable income by the rate for that particular row, and then adds the cumulative tax that we extracted from the taxes column. Finally, we created a cell which identifies the marginal tax rate. Again, we utilized a conditional formula that would set this equal to 0 whenever there was no value reported in the taxable income column. And otherwise, we'd take the total taxable income, add the additional dollar, and compare it to the bracket maximum. If the value of the taxable income plus the additional dollar exceeds the bracket maximum, then it would pull the next tax rate. Otherwise, it would pull the tax rate on the same line. While we were able to identify the marginal tax rate using this, we needed one more set of formulas to identify the highest statutory tax rate. In this case, we used the max function to identify the maximum tax allocated to a particular bracket, and then we used a combination formula, the sum product formula, to identify the matching tax rate on that bracket. Once we had used the tax rate schedule to compute the federal tax liability and identify the highest statutory tax rate and marginal tax rate, we referenced these values appropriately on our Input-Output Summary tab. We finished this data analytics project by computing the average tax rate. Here you can see I used an additional conditional formula that would allow it to be 0 if the federal taxable income is 0. Otherwise, this formula takes the tax and divides it by the federal taxable income. I computed the effective tax rate by dividing the federal tax by dividing it by our gross income, which in this case, we only had gross wages. I hope that this video has been helpful in reviewing how to manually compute the tax liability and the various tax rates that we use for decision making, as well as to see the full linkage between what we had learned in class and the manual computations of these numbers with the programming that we had to do in Excel to get it to automate that process.